everyone. Thank you for coming. My name is Maria Marks from Massive Capital. And thank you, Bobby, for that introduction. I appreciate it. We are here to bring you Creekside at Chatham. It is a 41-unit property in Pittsboro, North Carolina.
There we go.
Got a great agenda. We'll go through the executive summary, our sponsorship team, the property and market overview, a business plan, some underwriting, and then how to invest with all of us. Just a quick disclaimer, we are not CPAs or licensed professionals. If you do have any questions about CPA that would need to go to your CPA, please direct it to them, not us. Thank you, thank you. So I'm going to introduce the massive side of the sponsorship team. We do have a large group, but it's full of people who love this property. And I'll introduce our massive side first. We've got Schreier, Sanjay, and Mike. Those are the principals of Massive Capital, followed by Trevor, Jasmine, myself, Candace, Axa, Angela, and Jonathan. They're all on our behind-the-scenes staff. Thanks, Jasmine, for waving. Appreciate it. We're here if you call us and you need anything. Those are the people you're normally talking to. We are also here with Senate and Monica, Tarek, Rochelle, and Matt and Nick. Those are our co-sponsors who are coming in to help us because they believe in this property probably more than we do. Massive itself is located in various states across the United States. We are in Colorado, Texas, Georgia, and North Carolina. The green locations are where we're currently in, and the blue are our target markets. We have closed about 9 deals. Currently, we've got 2 under contract and 1 in a waiting list. Pass it over to you, Bobby.
Outstanding. Awesome, Maria. Thank you so much. And thanks everybody for joining on a Monday night right before Monday Night Football. So I'm Bobby Matus, and John Allen, who'll join who'll comment a little later, is our business partner here with Blue 22 Capital. And I like to say, so we just saw a slide of Massive Capital, and then there's Blue 22 Capital, is kind of the lead co-sponsors, and it's that symbiotic relationship where, you know, I like to say that Massive Capital is a lot like an umbrella that looks for partners like Blue 22 Capital that are boots on the ground. So it's like all good partnerships, both bring different things to the table, but they've got great reach, great software, great experience, and complementing us that are John and Bobby and Blue 22 team here on the based out of Raleigh, North Carolina. So we'll jump into the content and jump into the executive summary of this awesome opportunity, Creekside at Chatham. We have this beautiful 41-unit, 5.88 acre property that's two blocks by 2 blocks, 4 blocks total away from downtown Pittsboro, and it's workforce housing. It's about 100K a unit, which is and this is the Raleigh market, and you know we're looking at overall 17 to 19% returns with 6 to 7% projected average cash on cash for the returns for the asset. So ultimately, and John will go in a lot more detail on this, but looking to over the course of 5-year hold, 2.1 to 2.2x is the overall expected return. And a lot of folks say, hey, why do you love this? Why do you believe in this? Why do you love this asset? And I just get carried away in the excitement around this. I'll go in a little bit about the in more detail, but I really look at it as an upside down triangle. Hey, when you invest in real estate, you really look for population growth and job growth. You got here in the state of North Carolina, it's number 3, right behind Texas and Florida, which are both much larger states. So you start at the state level, and then you go to the research, triangle, which is Duke to UNC Chapel Hill, and then NC State. You get a lot of the Raleigh area job growth, and we'll see on a map where you're getting a significant growth of folks moving into the Raleigh area with expansion of A-class firms like Google, Fit Meta, and also the life sciences around Triangle Park. That's a lot of the infill that's growing there, and then you move a little bit over to Chatham County. Chatham County is where you're getting a lot of more of the greenfield development. So lots of folks. It's a county that's it's 20 minutes south of UNC Chapel Hill, and 25 minutes from our houses in Cary and Apex. So about 40 minutes from the airport of Raleigh Durham. So you're getting a lot of population growth. You're getting a lot of A-class growth in terms of the homes that are being homes, and then the big players are making mixed-use investments. So there's a $7,100 acre investment for 22,000 new homes and apartments. So the plus Riverside, which has got a $1 to $3 million homes. There's a Sweetwater, another development along 64. So you're seeing the large real estate players are making major investments in the Apex to Chatham County corridor. That is, as one article said, it's a unicorn area right now. So you've got a lot of that A-class growth growing there. Also, there's three workforce drivers. Workforce meaning, hey, there's these Toyota has a battery plant 33 minutes away. There's a computer chip manufacturing company about 29 minutes away, west in Siler City. West in Siler City, and then southeast there's a manufacturing site for VinFast, which is electrical vehicles. This is a big positioning that North Carolina is doing to build on the history of manufacturing, and within the global context right now, where there's a lot of reshoring of manufacturing, we're going to see a decade-long increase in that. So you've got a lot of growth, and then you've got a lot of the workforce magnets. So and the cherry on top being so close to the downtown. But really, the investment thesis is there's a lot of drivers for workforce, for A-class demand, but there's a lack of housing that is not the $1,600-$1,700 one bedroom. Where is that market for just the more basic? And you'll see a little bit that there's a dearth of that. This is just as we were talking a little bit earlier. We're as a partnership with Massive Capital. This is our second time executing a very similar business plan. The other one we have down in Fayetteville, and it's a similar business plan. Find an undervalued asset in a very central grade area. So you find a C-class asset in a B-class neighborhood, and that's been neglected, and fix it up. This one we took from a farmer that had not paid a lot of attention to it, and then within 8-9 months, we brought it up 60% in terms of increased income, and then have just been exceeding pro forma on our distributions within 6 months with it. And so this is when we found this property, we're like, we connected with Massive, and we're like, let's do it again. And so that's our plan on this. So just illustrating here, the pro forma being the red and the blue being our actuals. So with the market, just kind of talking a little bit about the market, that this is getting, I should really flip those slides, because this one I think is just visually allows folks that know North Carolina and those that don't to see a little bit about the strategic positioning of Pittsboro in the middle between the Raleigh Durham, the growth that's occurring there from A-class. That's been infilled a lot during this low interest rate, high growth. And then you've got this North Carolina core, which is a decade-long effort for the state of North Carolina to attract transportation dollars, and attract and develop these advanced manufacturing mega sites where they'll have an anchor firm. So the Siler City is where the computer chip manufacturing. In Sanford is where the VinFast, the electric vehicle manufacturing, is going to be occurring. And then up in Greensboro is where Toyota just announced new jobs, 1,700 jobs, I believe it is. So within all three places that are within half an hour away. And so very strategically located. This is just a shot into the blue, which is Chatham County, showing that it's connected to a lot of the universities and young folks who will be looking to work at these magnets of advanced manufacturing. I mentioned this. This is the there's a lot. I didn't have enough articles to put in here, but I didn't have enough space for all the articles that I wanted to put in here. In the sense of just there's a lot of growth going on there. So a lot of those A-class homes and then a demand for, with the A-class homes, there's gonna be a demand for the services around that. Plus, in this downtown, if we're looking at this photo, you get to see that this, similar to, if you know North Carolina, between Greensboro and Raleigh-Durham, the bedroom communities such as Mebane, Burlington, have developed into their own rights of destination small communities where you get the brewery, the hipster coffee place, etc. This is developing the same fashion. So it's a good example, and to be able to buy something at 100K, 2 blocks north and 2 blocks west of the downtown, is a really a great, given the precedent, it's a fantastic opportunity. And then on top of that, it is the county seat. So right behind this is the Chatham County seat where all the municipal offices are. So again, lots of drivers and really well positioned. You've got the population growth, the median home being around $700,000 now, and just all just pointing into this is a burgeoning area. So that's kind of brings you from an overview, and then here's the market, and then here we'll talk a little bit about the property. Again, on 5.88 acres, it's 8 buildings of bungalow style, of 1978 vintage. So lots of area. The older, so it's the previous owners had rehabbed some of them, but it's really what our business plan is really positioning this as just a nice, good, clean, quality asset, refurbishing it in terms of giving that modern presentation versus more of an older presentation of the asset, and someplace that folks would like to call home. Also introducing some dog park area over there on the left, and trail walking in the back. So as similar to what we did in Fayetteville, it's a kind of a 4-step process in terms of taking over the asset and applying the business plan. It's really about the takeover and transition initially, looking at the transition of the subsidized units that are under market, and then also mapping out the conversion and rehab plan. Then, as we're optimizing the exterior updates in our operations, and then as units are turning, we're doing the interior upgrades. We also have an office, what was originally a 1-bedroom, the prior owner used it as an office. We have a property manager that's based out of has a team based out of UNC that's 20 minutes away. So there would be operating, so there's no need to manage it from the office, since then they're in the area to address any of the elements. And then at the end, once stabilized, we can have an opportunity to watch the market to see when there's either a refi opportunity or an exit opportunity. And that's where we are on a couple of different properties down in Fayetteville. The exterior upgrades, kind of seeing that where we can do low cost but high impact upgrades that'll give young professionals, young manufacturing workers pride in place, address some of the external issues of the driveway and the pine trees that can make it a better quality location. And then there's a lot of dogs, but giving them a place to run, plus some potential for storage behind. So great 5.88 acres. And then there's the value add opportunity in the internal part is to really giving that modern look with the luxury vinyl vinyl plank flooring, getting a rehab on the cabinets, getting a rehab on the walls, and getting rid of those golden fixtures and really going with the brushed nickel hardware and light fixtures. When appropriate, putting in the stainless steel appliances, so that when there's a lot of these, the ones that have not been turned have not been touched in a long time. So when you look at them, they've still got carpet, etc. It's really giving this the brightness of a nice modern look, and that gives somebody the ability to say, hey, you know what, I value this place, and it's a good place that I can call home. So that's a little bit about walking us through kind of the big picture, walking us through the market, walking us through the asset, the property, and then the business plan about how you can add value. And then what everybody looks for in their investments is turning it over to the numbers, and that'll be John.
All right, thank you, Bobby, and good afternoon. Well, good afternoon, good evening for most of you by now. You want to go on the next slide, Bobby?
You go.
All right, so here we're looking at, and Bobby had to mention in terms of just the general return. So we're looking at, it's a 5-year hold. We're looking at annualized returns for limited partners of somewhere between 17 and 19%, and about 6 to 7% of that is made up of cash flow, and then the rest comes from the equity that we acquire upon the increased valuation and successful exit from this property. The way we have this investment set up, and so you have the general partners and the limited partners. The general partners are the sponsors, so it's Blue 22 Capital, it's Massive Capital. We're considered the general partners, the sponsors. The investors are what we call the limited partners, the investors. And so the way this is set up is it's called a 7% preferred return, and then a 70-30 split. And what that means essentially is that the first 7% of any return, whether it's through cash flow or whether it's through the equity acquired through the successful disposition of the asset, will go to limited partners. So the general partners, the sponsors, us, we don't see any profit, any income from this property until we at least hit a 7% return. So that first 7% is directed to the LPs, to the investors. Once we hit that 7% preferred return hurdle, after that, all profits are split 70-30, with 70% going to the limited partners and 30% going to the general partners. What this looks like just in terms of a cash flow perspective on a 5-year time horizon, with an initial investment of $100,000 as an example in year 0, we're returning $216,000 in year 5. And you can see there's a component of that, which is the distributions from operating cash flow. Starts off relatively light in years 1 and 2 because we're focused on obviously stabilizing the property. We're putting a lot of reinvestment back into doing the rehabs, doing the renovations, getting it up and running, moving it up more towards the premium market rents. And from there, we start seeing the cash flow stabilize at around 7 to 8%. Towards years 3 through 5, and then we have that big equity capture upon the exit. And so that's where we get to that equity multiple of between 2.1 and 2.2 over a 5-year hold. And just to mention, before I forget on this slide as well, we as the general partners are also investing as limited partners. So it's not as if, in addition to all the risk money that the general partners are putting into this investment, into this opportunity, everything that's required leading up to the close of the property, we're also investing 10% of the total equity raise as general partners. And so that's, we're putting our own investments into this alongside our investors. And so we think we're very well aligned and incentivized, of course, to make sure that this property performs. For rent comps, and this is important because our business plan is based on doing these value-added improvements to the property. We're going to go in, we're going to do interior, exterior upgrades. We want to get this property from a C class to a B class property. So what we want to do is we want to look at comparable rents for other B class properties in and around the area. And what Bobby had mentioned before about this dearth of workforce housing, you can see in this in the map in the lower right hand corner, you can see this is from CoStar, which is a market research tool that commercial real estate investors use, where we can pull rent comps. The average distance for a comparable workforce type apartment complex is 17 miles away. And so there really is nothing in Pittsburgh proper. And you can see just the amount of constrained supply. If you look at for comparable apartments for 1 bedrooms, you look at the number of units coming online, there's actually negative units coming online. So you're seeing just a 0.8% vacancy on 1 bedroom apartments. And then you're seeing just a 1.7% vacancy, and you're seeing again negative units. So units actually coming offline, not coming online. Whereas you see in the Class A apartments, you're seeing a lot of units coming online. You're starting to see vacancy increase with the anticipation of additional population coming into the area. So we're seeing an opportunity here for where there's very limited opportunity for workforce housing in Pittsburgh. We see a lot of the employment drivers that are close by. Bobby went over why we really like Pittsburgh proper, and just see a lot of opportunity really for forced appreciation over the hold of this property. And here we're just looking at what our pro forma income is. So we're looking at operating revenue, and what I'd like to highlight here is that you see most of the additional revenue being generated from our renovation premiums. And so we're just budgeting for 3% market rent growth, which is just for everything we've seen in Pittsburgh and in Chatham County over the last 3 to 4 years, albeit things are slowing down nationwide. 3% 3% annual market rent growth for this market in Chatham County is conservative. And so we don't want to make it look like we're getting all of our rent increases by exaggerating just what the general market rent growth is going to be. We're capturing most of the increase in rent growth from our renovation premium. So it's carrying out our value add program, making updates to the interiors, to the exteriors, taking it from a C class kind of classic as is property to a B class with premium interiors, with cleaned up exteriors. And that's what's really going to drive the rent growth that will allow us to get the valuation that we need moving forward to be able to have a successful exit on the property 3 to 5 years out. And then for expenses, this is there's a lot obviously here in this slide. There are a lot of expenses that we need to control for. This is for a property of this size, which anywhere from a 30 to a 50 or 60 unit apartment complex, what you would see on average, and the sort of the metric for controlling expenses is it's the operating expenses as a percentage of our total effective gross income. For markets of this size and this vintage, you're looking at somewhere between 30 to 35% on average for operating expenses as a percentage of our effective gross rents. We are at 40%, just in terms of how we budgeted for this. Is at close to $6,500 per unit per year, which again, for those that invest in similar value add properties of this unit size, it's a pretty high number. We're increasing considerably in a number of expenses compared to the current operating statement. You will see that there is a move from you'll see the personnel expenses. This is currently being managed on site, and so there is the current seller. The seller for this property has another small property close by. It gets into about 60 units between the two properties, and on average, you need somewhere between 75 to 80 units to really justify having a property manager on site. So they're expending quite a bit in personnel for this property, and there we see a lot of opportunity for operational efficiencies. And so by moving from on-site property management to off-site property management, as Bobby mentioned, we have a really, really good, strong property manager that's just based 20 minutes away in Chapel Hill. is managing properties of similar vintage and unit size, both within the Raleigh-Durham area and also in Winston-Salem. Been very happy. We just had a call from this afternoon, kind of going over the takeover plan, really on top of things, strong property manager. And so while we're increasing operating expenses to make sure we're conservative and covering things such as landscaping, such as repairs and maintenance, we see operational efficiencies with how we can actually do the property management. And so we're quite confident here in terms of our pro forma expenses.
As a reference point, on our other property, we're managing in the high 20s percentage-wise and low 30s.
And then for our exit, we're projecting this investment for a 5-year hold. And so one of the things that's important, one thing we haven't talked about yet, is the financing on this. So obviously the investors, limited partners, put in the equity to cover the down payment and then to cover some of the closing costs. But most of the capital for this is being financed by through commercial debt, through bank. And for us as operators, and this is something that Bobby and I have managed for other properties, we're very our mindset is focused on securing long-term fixed interest rate debt. And with everything going on in the market right now, for those that are following real estate, that are following what's going on with office space and some of the large metropolitan areas, some of these investments that were made with short-term bridge funding, with variable rate interest, and things are coming home to roost now, and you're starting to see that as banks are starting to call loans due and operators scrambling to figure out how to go from paying an interest rate of 2.7%. We were on a call today, Bobby and I, and we were talking about an operator that operates here in the area that bought somewhere around 2,800 units and over the last 2 or 3 years with variable rate interest at 2.7%, and is now those bridge loans are coming due 2 years later, and rates are jumping up to from 3.7% to 7.7%, 8.7%, and they can't make the deal work anymore. For us, we've secured a 5-year term fixed interest rate loan. The returns that we're showing for this property of 17 and 19%, taking consideration holding on to that loan for the entirety of the 5 years. That being said, we're going to look for opportunities to exit early from this deal. If we can look at a refinance, if rates come down over the next 2 to 3 years, we're able to complete the stabilization of our property. We're able to raise rents, and we can look at a refinance that will allow us to return a significant portion of our investor capital. We will do that. We'll also look for opportunities to exit early. And so if we can really push our operations and get rents up and hit our net operating income target of around $420,000 a year to allow us to exit early, then we will do that. And obviously, we understand that it's important to recirculate investor capital as quickly as possible. So to the extent that we can exit early and meet our returns, we will do that. But we're positioned to be able to hold on to this property for a 5-year term without having to worry about interest rates or having any capital events that would force us to have to exit early. It'll be a voluntary exit if we want to do that. I'll just end on this slide stating that one of the things that's important in the way that you value commercial real estate is you take the net operating income of the property and you divide that by something that's called the capitalization rate. Not to want to get into too much into the weeds, but to the extent that your cap rate, whatever the cap rate in the market is the multiplier, which will determine based on your net operating income what your total valuation is. We've gone in at an exit cap rate at 70 basis points higher than our entry cap rate. And so we're being conservative in the sense that we expect over a 5-year hold that although cap rates are starting to decompress a little bit now with obviously interest rates going up, we'll see, and what we see for this property and for this market in Chatham County, given the population growth, given the job growth, we're going to see over a longer term hold on this, we'll see most likely cap rates come down. And so again, we're very well positioned with a cap rate that's higher. Our exit cap rate is higher than our entry cap rate, so that gives us some additional margin there as well when we want to sell and exit this property.
That's it. Yeah, that's great. Did you want to share about the what the bank's third-party appraiser thought about it?
Oh, yes. Yeah. So this is obviously another important part of the financing. So banks will not take our word in terms of what we think the valuation of the property should be 2 or 3 years out. Obviously, the bank is going to hire their own appraisers, and banks will send their appraisers out. Independent appraisers will go out, they'll take a look at the property, and then they'll value what the property, they'll give a valuation of the property 2 years out upon completion of our value add stabilization program. So we're purchasing this property for 4.1 million. The bank's appraiser went out and appraised this property, and they're putting the valuation 2 years out. So we're talking about October 2025. The bank has valued this property at 6.15 million. So you're looking at a 50% increase in the valuation over just a 2-year period. And that's an independent bank's appraisal on this property.
That's outstanding. 4.1, put 6 on top of it, and then value it at 6.1. So not bad. Yeah, awesome. So that's
Thank you.
pass
Thanks,
it over to Maria.
John.
To say, how do
Thank
I
you,
take
John
back-
and Bobby. It's always great when you love the property so much, but then the bank also sees your passion in it and sees that excitement. So I hope you guys were able to see just how much we truly, truly value this property. It is a diamond in the rough. It is right off the beaten path, and it looks like it's in the middle of nowhere, but it is very close to shops all around it. It is an amazing location with an awesome awesome opportunity to make some good money here. So this projection does show that we are closing October 27th, but that has already come and passed. So we did extend our offering a little bit longer. It wasn't on our end. It was on the bank. The lending side was the one who controlled that. So we do have a little bit more time, meaning that we're able to get a few more of you in this deal. This deal is open to accredited investors only, but we are taking LLCs, we're taking IRAs, taking individual investments. However you want to invest, we can work with you on that. So we only have a few spots left, and which is why we're doing this webinar, because we love it so much that we wanted to give you an opportunity to invest in this deal. So with that being said, if you were brought here by someone, please use their code to get into our deal. If not, and you don't remember it, there is a link right here. It is in mine and Jasmine's background. You can see it'll take you right to the portal, and we can get you to the right sponsor that you need to be with, and we can help you fill out that paperwork. Do not sleep on this opportunity. There are only a few spots left, and I don't want you to miss out on something that's closing in 2023. Please take advantage of that bonus depreciation. It is going from 80% to 60% next year. So make sure you take advantage. If you're wanting to take some tax advantages off of your 2023, make sure you get in now. Like I said, we only have a few spots, so it is first come, first serve. And we hope to see you in this opportunity. I know Jasmine's been putting some links in the chat, and I would love to open up to you guys to see if you have any questions. I'd love to help you get more on our side and love it just as much as we do. So thank you, everyone. This is the end of our presentation. We'd love to open it up, see if we can help you.
Yeah, there's some questions on the chat.
Awesome. We've got one in the Q&A. What's the latest on Chatham Park?
It is booming. It is a Chatham Park, 7,100 acres. This is the investment. So this is 6 minutes from our location, and that is an investment from SAS, which is a software company here. The gentleman Jim McKnight, who in the past couple of decades invested in Cary and the Preston development, and really made the suburbs where this was all right outside of Cary and Morrisville developed that. He's now 80 years old, but bought that land to develop that and have different mixed use, different home developers, etc. That is going full force and developing well. There's also another community called Sweetwater that was just developed on 64. There's also another development that was called Riverside. But there's multiple developers making investments out there. So you're getting, again, A class, where you're getting homes $500,000, $600,000, $700,000, $1 to $3 million. That's driving mixed use that's going to be there. Those that are working at the mixed use places, those that are working at the bars, restaurants, antique shops, those that are working at the county seat will have an opportunity to pay $1,700 for a one bedroom, but there is not many opportunities for what's currently $950 to then have an $1,175 one bedroom that's been newly refurbished. So that's where we see that as a positive thing, and all this growth will drive a demand for the type of product that we uniquely have. So.
Another question. What is the interest rate on the loan?
Interest rate on the loan is
John, it's 7.75%. So 7.75%, it's fixed. What we like about this, I mean, nobody likes an interest rate at 7.75%, especially after having interest rates down in the 3% range. But what we like about this is we get 24 months of interest only, which helps out with cash flow during the value add. And then what really fits into our business plan is that there is no prepayment penalty. And so if we want to refinance into agency debt at some point, there's no penalty that we have to pay. There's no fee that we have to pay to the bank because we're exiting out before the 5-year term. So if we want to refinance, if we want to sell the property early, we can do so without having to pay any fees, any penalties. And so for us, it was more important for us to have, a longer term and paying a bit more in terms of the interest rate, but then having the flexibility for us to be able to refinance out or exit early without having to pay significant malfeasance or prepayment penalties.
Fantastic. And then I saw another question.
There's one more, and Bobby, you might have to go back to one of these slides. Could you please revisit the renovation cost per unit? Noticed 11 tenants have subsidized rents. What is the average tendency when they're due for renewal to implement the business plan?
Fantastic. Yeah, Asif, thanks for the question there. So one on the renovation per unit cost. So we've got kind of A's, B's, and C's across the 40 units. And where some are that need a whole rehab, some that have partial rehabs with already LVP flooring and are in good condition that the previous owner had done. So I think we're averaging about $8,000 to $8,500 per unit. We've got that a contractor that we used on our previous property that's going to be executing on that, and that they've done. I think they've just quoted on a recent rehab like $8,700 for the full rehab. So we've got about $8,000, $8,500 for A's, B's, and C's rehabs. So we're comfortable that we've got enough wiggle room in that.
I'd just say for a full rehab on the 2-bedroom, we're looking at $12,000 for and then about $8,500 for the one bedrooms for full rehabs. But we're not needing to do full rehabs on all the units. And so there's about 16 to 18 that already have partial rehabs in place. So that brings down the average cost to around $8,500. But if we're looking at a clean, taken from a classic, hasn't been touched in 10-15 years, to bring it up to premium, it's about $12,000 for a 2-bedroom and $8,500 for a 1-bedroom.
Great. And then the second half of the question, the subsidized housing. This is these are all coming. The majority of them coming on due in 2.5 months after takeover of the property. So where we're working with the local board in order to just to communicate that, hey, we're going to market. How do we best deal with these tenants? So, and then transition to a market-based property versus a subsidized property. Jeff is asking, who's the property manager and what's your prior experience with this property manager? This property manager, Clay Realty, who managed about close to 400 doors in the area, came super highly recommended from our Marcus and Millichap broker. And right away, what impressed me is we've been working with them for the past 4 months in terms of just doing the diligence on this property. Right away, what's distinguished him from other property managers, he thinks like an owner. So thinks like an owner, meaning he knows where we're positioning this. We've shared the business plan with him, and really made him a partner in executing it. And so realizing that, all right, what's the sufficient investment that we need to make in order to position this property versus over positioning it. So go ahead.
Sorry, this is not the property managers that we have for the other asset in North Carolina, right?
Correct. Those are about an hour and a quarter away where Jackson Brown's based over in Fayetteville, and they manage a couple of our assets over there. It would just be a longer distance from their strength and their hub, and that's why we came across Clay Realty through our broker that he came highly recommended.
Awesome. Okay, thank you. No, because Jeff is part of the other asset as well, so just wanted to make sure.
Outstanding. But the other asset is going to be doing our rehabs. They've done a great job on turning those units. So that Spud Jackson Brown has a sister company that is a contractor company, Seasons to Seasons, and they really have a great workforce model that they do with that really. And they do it at a very great price. I think when you have that market in Raleigh, you get a higher price point. We're bringing in our contractors that we have experience with doing this turn that's really focused for workforce. So we're got the best of both worlds in terms of a local property manager that really knows the area and is close by and thinks like an owner. And then our other property manager that we have experience on turns will be working to do those turns with them.
Good team. I love to hear that, and to just be able to know that they've already worked with us for the past year on the other property. It's a good team to have behind you for sure. What is the entrance cap rate? You were talking about the exit cap rate, John.
Yeah. So the market cap rate's at about a 5.2 right now. So that's if you're asking in terms of what the acquisition cap rate is based on the recent T3 operating statement, it's somewhere around a 5%. But what we're seeing based on our sales comps and based on what we're getting out of CoStar, and just in conversations with brokers, we're seeing that the market right now for Chatham County is like around 5.2. And then obviously we're looking at an exit of 5.7. So we're looking at, a decompression down to 5.7 for our exit. But again, we expect this to be below a 5 cap once, looking 2 to 3 years out, as economic growth and some of these drivers that Bobby had mentioned are continuing to come online. We see the county growing, and we see the demand for workforce and for job growth really to continue to push down cap rates.
When do you anticipate distributions?
Alrighty, show me the money, right? Like when?
Yeah, exactly. And actually, will you go back to the slide that has the $100,000 investment?
I was just thinking that as well. Great minds think alike there, Maria.
I love that.
There you go.
Yeah, I mean, I would say most likely for, and this is similar to what we had on our previous properties, we're probably looking at our first distribution at month 6. And so that gives us a chance to get in, to take over the property. We'll be doing some immediate turns and getting some rents up. We'll be renovating some or renewing some of the leases. And Bobby had mentioned there's some subsidized rents that we'll be phasing out in January and February. And so, you know, the cash on cash and the income for distribution is going to be low the first couple of months. One thing that I should mention, and that should be that I should have mentioned is that we're looking at we have 50,000. Part of what's included in the total equity raise includes an operating budget of 50,000, and so that gives us almost 4 months of operating expense coverage. And so that does give us, if we need to dip into operating reserves to help us, you know, during the first couple of months. We don't anticipate that. We haven't had to use our operating reserves for any of our other properties, but you know, we're going to see low income for the first, you know, low net income for the first 3 to 6 months. And so we don't want to, put the property at risk by doing distributions month one. So what we'll probably do is make our first distribution at the end of our second full quarter, and then we do quarterly distributions. So on a quarterly basis, we'll send out what the distribution is. We've been doing, and something Bobby may want to mention, we've been doing with our other properties, we're doing monthly updates, and so we're giving our investors the opportunity to have monthly video call updates with us. And so we're doing
Quarterly.
updates on them. Oh, quarterly, I'm sorry. We're sending out
video, monthly.
we're sending out updates on the
There you
property performance on a monthly basis, but we're doing investor call on a quarterly basis, and we're doing distributions on a quarterly basis.
Yeah, it's all in the spirit of transparency and keeping comfort as business partners, and as in life that we've done. It's not that things won't go wrong, but it's how you handle them and how you communicate them, and how do we plan A, plan B, plan C,
Exactly.
to manage that. So we've been doing that.
And one more question.
Yep.
What considerations did the bank appraiser how did they come up with the 6.1 valuation in 2025? Was it the renovations, the market, population growth? What did they take into account? If you know that.
So what the bank does, the bank will take, we'll give the bank our information in terms of our projections. We'll give them our rent comps. They'll take a lot of that information and they'll pass that information on to the appraiser. But what the appraiser is going to do, just like any sort of underwriter, is to go in. They'll do their own rent comps. So they're looking to see what, we're taking this from a Class C to a Class B. So they're looking at what comparable properties would be in the county, in the market. They're projecting. They have their own sort of macro indicators that they utilize, sort of project forward rent growth, market rent growth, and so they have the information that we sent them, but then they obviously go out, they visit the property, they go through, they do tours of the units, they take a look at our business plan, so they understand what we're trying to do, and so they know that we're taking this at sort of classic 1980s as is. Interior, and we're going to be renovating it. We're going to be putting in, $12,000 for a 2-bedroom, $8,500 for a 1-bedroom. We're going to bring it up to this finished style, sort of a premium style, where you're seeing the LVP floor and you're seeing sort of black or stainless steel appliances. You're seeing the new fixtures. So they take that information, they run their numbers, they look at their rental comps, and they come up with a valuation that they give to the bank.
Great.
And the last question is, who's responsible to oversee and manage the property manager for this property? Bobby and John?
Great question, Jeff. And that'll be the asset managers. That'll be ourselves. I think, so this is one of the great things of actually that you've got, the co-sponsors living 25 to 30 minutes away from the asset. So in dividing responsibilities, I'm in charge of the physical asset. So one is just working with the property manager with the business plan and kind of the key performance indicators that we need to reach. That's kind of the kicking off of that. But then also we meet meeting on a weekly basis once stabilized, but probably at the beginning more frequently, and be much more on the property and just in terms of getting it stabilized. And then as an asset management team, and this is part of the strength of the Massive Capital, Blue 22 Capital partnership, is that on a monthly call we manage by indicators. We manage by balance sheet and income statement, and we've got our pro forma, and that's where we as a team look at where we are and then tap the collective knowledge that is to address any issues. On a previous property, I had an issue with an air conditioner, and then Sanjay from Massive Capital is like, "Is that a 1/4-inch pipe or a 1/2-inch pipe?" And I'm like, "Great point." And then he brought his wealth of experience there to address it. So it's really it's a team effort, but we're really happy to have a great property manager, on top of it, asset manager, and then the collective team with the general partners, and keep that communication in turn to our limited partners that are making these investments, so they're comfortable and can always, our doors are always open. So for that transparent communication and answering questions.
We should mention as well, there is a new brewery that just opened 4 blocks from the property, so it won't be.
And I wonder, how'd you guys find that one? Did you do some market research?
We don't have to twist our arm to go out and make sure we're doing asset management on that one now.
I love that. And that's when it's really, really nice and close by. Like I mentioned before, this is for accredited investors only, but there are a few ways to see if you are accredited. So if you want to book a call with Jasmine or even myself, you can at the link that Jasmine put in the chat. We can walk through some ways to see if you are accredited. I know this is only such a great opportunity. It's for accredited only, but there are a lot of ways to become accredited. So maybe there's a way we can slide you on it.
Yeah.
I did see some signups already on Cashflow Portal. So like I said, it's first come, first serve. I don't want you to miss out on this opportunity. Come join our team. We love this property,
Hey,
and we
Maria.
hope that you showed that. Yes.
Sorry, but there is another question on the chat. I need
perfect.
to go to the other webinar, but if you guys can respond to us all on that one. Okay. All right.
Yeah.
Yeah,
And
great.
if you
Yeah,
have more
I think-
questions, I'll be more than happy to help you. Okay.
Awesome.
Thank you. And bye-bye.
John, they're asking, how do you project the capital raise? Is it based on purchase price or expense? It's kind of
so
what's
this
the
is, we
capital
should,
stack
yeah.
Yeah.
There's so this is basically the sources and uses. So where are we sourcing the funds and how are we using them? So we're looking at a total all-in investment of 4.8 million. So we're purchasing the property for 4.1 million. There's an additional 700,000 for CapEx and for closing costs. And so I think Bobby had mentioned we're looking at around 620,000 in CapEx expenses for both interiors and exteriors. So we're looking at 4.8 million in terms of our sources and uses, and then that is being split up where the bank is providing us a loan for 2.3 million, I believe, and then they're also providing a line of credit for 700,000 for us to draw down on those CapEx expenses and to cover the closing cost out of pocket for that. And then there's the additional 1.8 million, which covers that remaining amount of the down deposit that we need to make, obviously, with the bank. And so that's where you're seeing, we basically calculate how much do we need in order to cover the cost of the property, cover the purchase price of the property, to cover CapEx expenses, to cover closing costs, to cover operating reserves. We add all that up. We see how much we can get from the bank, and then what's left over is what we do for the capital raise. And so that 17 to 19% annualized return for LP investors is based on that equity raise of 1.8, probably around 1.82 million as we close on this.
Great questions, you guys. And I don't want to cut you guys off. So if you have any more, feel free to put them in the chat. But like I said, Jasmine did put our link to ask more questions. If you have any, you can book a call with one of us. We're here to help you. And Bobby, anything else before we?
I think it's I can talk about it all night, but I think it's a lot of people ask why are we invested? Why are we such believers? You know, often you invest for appreciation, often you invest for depreciation, often you invest for the cash flow. This particular asset and the fact that we found it off market with a seller that needed to move it quick in order to have access to liquidity, I think we found a very good deal that if you've got the time to set it and forget it, I think you'll be very pleasant. We have a lot of confidence in this asset. So
yeah, I'd just like to thank everyone. You know, thank you, Maria, and thank you, everyone. I think what 45 people on the call. I think this was our probably our most popular investor webinar for this property so far. So thank you everyone for taking a Monday night start of the week. It's not easy, so just appreciative of your time, of your interest. And again, we're more than happy to answer any additional questions. If you didn't want to ask a question online, we're happy to answer a question offline. We're happy to get more into the numbers for those that like getting into the numbers. So please do feel free to reach out to us if you know, if you want to carry forth the conversation offline.
Yes. So thank you guys. Thank you all for coming. And we hope to see you join our team on this deal. And if you have any questions, please do not hesitate to reach out. I hope you guys all have a great evening and hope to see you on the next call soon. Thank you, everyone.
Awesome. Very good. Thank you guys very much. Let's get this one across the line. Wonderful. Wonderful. Thanks, Maria.